Modern banking operations revolve around interconnected activities of deposit taking, lending, and investment. These functions underpin the fractional reserve banking system, enable money creation, and facilitate economic growth. Here's a detailed, structured explanation. Banks don't take deposits in the traditional sense. Contrary to common perception, banks do not merely hold deposits for safekeeping. Instead, legal nature of deposits. When you deposit money in a bank, the funds legally become the bank's property. The bank records your deposit as a liability on its balance sheet because it owes you that amount on demand. Operational use of deposits. The bank can now use these funds to extend loans, invest in assets such as government securities, meet reserve requirements mandated by regulatory authorities. This reallocation of deposits demonstrates that banks do not act as mere custodians, but actively use deposits to generate economic activity. Loan the bank money. Deposits can be viewed as loans made by depositors to banks. Debt creditor relationship. When you deposit money, you are effectively lending it to the bank. In return, the bank may pay you interest in savings or fixed accounts, much like a borrower repaying a loan. Liquidity and funding. The bank pools these funds and uses them to extend credit to borrowers, invest in income generating assets such as securities. Fractional reserve banking. Banks are only required to keep a fraction of deposits as reserves, enabling them to loan out the majority. This process multiplies the money supply and fuels economic activity. Banks purchase securities. Banks are not only lenders, but also major investors in securities. This practice serves multiple purposes. Liquidity management. Securities, especially government bonds, provide a liquid and safe way for banks to park excess reserves. Earnings, diversification. Investment in securities generates interest income, providing banks with a steady revenue stream. Regulatory compliance. Banks often purchase securities to comply with regulatory requirements, ensuring they maintain adequate liquidity and capital reserves. Interplay between deposits, lending, and securities in banking operations. These three activities, deposit taking, lending, and securities investment, form the core of modern banking operations and are intricately linked. Fractional reserve banking. Banks maintain a fraction of their deposits as reserves, as required by central banks, and lend the remainder to borrowers. For instance, if the reserve ratio is 10%, a deposit of $1,000 enables the bank to lend $900 while holding $100 as reserves. This $900 loan is deposited into another account, further fueling the lending cycle. Money creation. When a bank extends a loan, it does not transfer pre-existing money. Instead, it creates a new deposit in the borrower's account, thereby increasing the money supply. This process underscores how banks create money by lending, as the borrower can now use the deposit to make payments, initiating additional economic activity. Investment in securities. Banks invest the deposits they do not lend out in securities, such as government bonds, for three primary reasons. Safety. Government bonds are low risk assets. Yield. These investments generate steady interest income. Liquidity. Securities can be sold quickly if the bank requires cash for withdrawals or other obligations. Banks as intermediaries in the economy. Banks play a pivotal role in connecting savers and borrowers while simultaneously acting as creators of money and investors. Connecting savers and borrowers. Savers deposit funds into banks for safekeeping and interest. Borrowers access loans for personal or business purposes. Banks bridge this gap, ensuring efficient capital allocation. Money creation. By issuing loans, banks expand the money supply, directly impacting economic growth and investment. Investment activities. Banks use deposits to purchase securities, supporting government funding and contributing to economic stability. Illustrative example of banking operations. Deposit. Customer A deposits $1,000 in Bank X. The bank records this as a liability, customers claim, and uses $900, assuming a 10% reserve ratio, for lending or investment. Loan. Bank X lends $900 to customer B, creating a deposit of $900 in customer B's account. This deposit can now be used for spending or further savings. Investment. Bank X invests in $500 worth of government securities, earning interest while maintaining liquidity. Economic multiplier. The $900 loan from customer B is deposited into another bank, repeating the cycle and amplifying the money supply. Modern banking operations exemplify the interconnected nature of deposit taking, lending, and securities investment. Deposits provide the foundation for banks to act as intermediaries, facilitating loans and investments. Loans expand the money supply, fueling consumption and economic activity. Securities investments enable banks to manage liquidity, earn income, and comply with regulatory requirements. This interplay demonstrates the dual role of banks as creators of money and stabilizers of the economy through efficient financial intermediation and investment strategies. The fractional reserve system amplifies these effects, ensuring that banks remain central to modern economic systems.